Hi friends, today we will see how to select a great company for stock investment. Basically, there are three types of businesses in the world: a good business, a great business, and a gruesome business. A good business is a business which gives 20 to 25% returns every year consistently for longer duration like 10, 20, and 30 years. A great business is a business which will give 15% return in the first year, and then it gives 25% in the second year, 30% in the third year, 40% in fifth or sixth year, and then it goes on to 50 or 60 or even 100%. Look at Nestle in 2001 and 2002. It used to earn about 25% return on equity. By 2011, it was 135%. You can see how it has improved year after year, and that's what makes Nestle a special and a great company. It clearly shows rising ROE. Now we understood very clearly what is a great and good business. Now let us see what is a gruesome business. The real challenge for the investors in market is to throw out gruesome business. Now what is a gruesome or a bad business? A bad business is a business which actually breaks the capital. Cost of capital is 10% and they earn 5 to 6%. Let us imagine on 1000 crore capital, a company is making 50 crores of profit, which is 5%. And if the company decides to double their profit, then they require another 1000 crores. So this company is making 50 crores of profit on 1000 crores. It is just 5% return on equity, which is very less. Most of the retailers get attracted to such companies because they are available at a very cheap rate, and those companies will remain in their portfolio because they are not making losses. Valuation is very cheap and hence it doesn't go wrong, is what most retailers think. But this is a wrong attitude. People don't make money in such kind of stocks because company itself is not making much money. Lot of people will have doubt how much money we can make in a stock. You make money as much as the company makes money. Let us take the current valuation of an XYZ company in is 1 crore. If you as an investor invest 1% in the company, and if the same company makes 1000 crores profit over a period of time, you will be earning a profit of 10 crores. A lot of people think that they can make more money than the company makes, and that's why they don't bother about the company's financials and they just bother about the stock price. This is not right. Always your focus should be on the company you invested in and how much money the company is making. Fundamentally, we should focus on the great businesses which will make lots of money not only now but in the next 10 to 20 years as well. 99% of people lose money in stock market because they have bad companies in their portfolio, and if you enter such companies into your portfolio purely because they are cheap, they will destroy your wealth. The four important points investors need to concentrate before buying any stock is: the first one is quality. Now what does that mean? Quality means quality of business, quality of management. We should also see how transparent the management is and how are they treating their employees, how are they treating the minority shareholders. The second one is the growth. You need to check the growth of the company you invested in. And the third one is longevity. The longevity of the growth, it is very important to see how long the growth can continue for the company. If the company grows around 20, 30 or 40% over a long period of time, like about 20 to 30 years, it is good. The last thing is price, which we pay to buy a stock. This is very, very important. After seeing all the parameters, investors should focus on the price, whether the price or value is justified to invest in that particular company. Investing in stocks is all about buying a business and not just a stock. Hence, it is really important for investors to concentrate on some of the most important parameters by which they will understand if the price is reasonable to invest in any stock. Now, we will discuss these parameters one by one. Let us first see what is EPS, earnings per share of the company. What is the first thing that you will look for in a company before investing? Obviously, whether it is making profit after paying taxes and consistently. But why? Because profit after tax is what shareholders get. Earnings per share is profit after tax per share. When you put money in a fixed deposit, you get an interest of 7%. That is, you get 7 rupees a year for a 100 rupee investment, in addition to a promise from the bank of getting back your 100 rupees at the end of the term of the FD. EPS or price is equivalent to interest rate when investing in stocks. So when you see the EPS of a company is 7, it means that you will get 7% of your investment. The next parameter we will consider is total sales and its growth. How do you know if a company will grow its profits consistently? A company can increase its profits by selling more and more every year. So you need to look at a company's net sales and check if it is growing consistently at a healthy rate. Sales can grow with a higher volume or higher price, preferably both. Growth in volume should keep pace with the growth in demand for the category. The third parameter we will talk about is the book value of the company. Book value represents the total amount a company is worth if all its assets are sold and all the liabilities are paid back. This is the amount that the company's creditors and investors can expect to receive if the company is liquidated. To increase sales in the long run, a company needs to invest in itself, and most companies plow back some or all of the profits back into the company to expand their capacity, increase their working capital, etc. Hence, the book value of a company is nothing but the total assets minus the total liabilities. Now we will see the next parameter, ROCE, return on capital employed. You need to check if the company is using capital efficiently. Companies, in the most basic sense, are money using and money making machines. How do you rate a machine? Simple. Look at what it produces in relation to what it uses. That is, its efficiency. Companies produce profits using the capital invested. Hence, to know the efficiency with which a company uses its capital, look at return on capital employed. An ROCE of 15% means that the company generates a return of 15% on the total capital it employed. Now let us see the next parameter, debt to equity ratio of the company. High debt companies are a problem for an investor. When a company borrows money, it should be able to repay it. That is the interest and the installment of the principal amount without any serious difficulty over a reasonable period of time. Debt to operating cash flow tells you the number of years in which a company will be able to repay its debt out of cash generated from its business operations. When this ratio is high, it means that the company will take a long time to pay off its debts and hence will pay a large, substantial portion of the company profits towards this. There will be less left for shareholders. And very importantly, in case of any challenges, for example, an economic slowdown or a workers' strike, it will face a crisis of default, the one thing that can send the stock price crashing. A ratio of less than 3 is considered acceptable. Some of the other parameters are dividend yield, the higher the better, PE, price to earnings ratio of the company, this would be the lower the better, PEG, Price to earning by growth ratio of the company. This is also the lower the better. PBV, price to book value of the company. This is also the lower the better. And compare it with different stocks in the same sector, because these ratios will be higher for few sectors and lower for few sectors because of the growth variations in different sectors. For banking, additional parameters investors need to concentrate are GNPA, gross non-performing assets, NNPA, net non-performing assets, PCR, provision coverage ratio, CAR, capital adequacy. But while you're considering all the above parameters, do not forget the three key behaviors of an investor. Investors should have vision to see the growth of the company. They should have the courage to buy and patience to hold, which is very important as a lot of investors lack this. Possessing these behavior is very important for any investor. If you see Infosys, it grew 8,000 times in the last 20 to 22 years. And any investor who held their stocks throughout would have benefited a lot. It is not how much you invested in stock market, it is about how much time you spent on the company by holding its long term. That is where your money will be compounded and your portfolio can see significant growth over a period of time. Stay tuned, we are coming up with stock specific analysis. Please comment below the stock names that you want us to provide a detailed analysis on. If you like this video, please do not forget to like, share and subscribe. Take care.